Hi, I'm Joel Palafinkel, and based on popular demand, I was asked to put together a beginner's private equity and venture capital 101 lesson. So this is for people that are just getting started, trying to break into the industry, trying to just sharpen their skills. But this is super beginner for people that are brand new to private equity and venture capital. So if it provides value, then I'm happy. So I'll start with the salary data because different careers, depending on where you go in your pathway, is going to vary. But in private equity and venture capital, I'd expect anywhere from 6 to 7 figures, and it can be all across the board. There's different titles, there's different compensation ranges depending on if you're in a big firm versus a small firm. So I'm just going to take the median from 2023, and this is a really good database. It's called Hendrick and Struggles. So you can go in there, check it out. They'll probably have the 2024 data coming out probably by the end of the year. So once we get that, we'll push that out. But the titles usually start out if you're just getting into venture and you're super venture or private equity, you're super early in your career. I'd expect to probably come in at the analyst level. Now, this has some data around the associate level, which is the one level after the first year analyst. Um, Sometimes if you already have work experience or if you have an MBA, you can just kind of come in at the associate level because they give you that experience, um, which is super valuable and does carry some weight. And then, if you pivot your career, we've helped people within our program, and we've just seen people make a pivot and come in at a higher salary, almost the same salary they had in a completely different industry. And that happened with me. I was an engineer, and I was able to come in at the junior partner and partner level, and eventually, co built a an opportunity to be a GP at a fund as well, before I built my own firm. But anyways, if you are resourceful, if you're able to build really good relationships and carry the weight of your past experience, you should be able to hopefully come in, at the lateral move. So, whether that's for you, lateral means being a principal, being an associate, being an analyst. Those are all things that you'll have to kind of navigate. But anyways, this report, just to kind of keep going here, breaks down the senior associate role. So if you look at the mean salary, it's around 160, but as you go higher, again, this is where it takes into consideration the size of the fund and the firm and how well you're able to negotiate and how well these people are willing to play ball with you. But on the high end, you're looking at 230, and then vice president, you're looking at 218 to 300, and then the principal is really for people that have a lot more experience, but this goes up anywhere from 300 to 500. And then as you go up the ranks on the high end, hopefully you can get to a 7 figure opportunity as you really evolve in your career. And that's the base, and then there's other things too, like the bonus, plus if there's carry, which definitely takes longer to generate because we're in a illiquid market oftentimes with venture capital, and it takes time to make the returns. But to summarize, what is private equity? Venture capital is part of private equity, but this is an asset that is not in the public stock exchange. You can't buy these products on the stock exchange. You have to know someone, you have to be in the industry, you have to be connected to be able to get access to these deals. But the main gist is that these companies are all private. They're not on the stock exchange. So this breaks up into really three categories. There's venture capital. That means you're investing in an early stage company. Think the show Shark Tank, right? You got someone who's built a business that has a little bit of traction. Sometimes it's even an idea. So that would be pre-seed. That means it's kind of an idea. Seed means there's a product out. Hopefully there's a little bit of revenue. And it's promising, it's on track to getting to product market fit. And then Series A is really when there's a price assigned to the company. Before Series A, there's usually this term when you're investing in the company called a valuation cap. That means the company is so early, there's no valuation. There's just kind of a placeholder valuation. But really, Series A is when the company has hit actual product market fit. They're generating some serious revenue, and they just need more capital to kind of really double down and scale much faster and much bigger than they are. But like that entry point is the Series A. And what's special about the Series A is usually there's a formal valuation tied to the company. So the valuation means how much is the company worth based on the assets of it, and how the type of company is related to the market. So for example, AI companies right now will probably be, a little bit overinflated, especially if you're in a tier one city. Now, beyond Series A, there's Series B, there's Series C. The check sizes go bigger, but there's a whole concept of growth equity. So that's just beyond early, beyond product market fit. You're just pumping in more capital to help the company scale to get to hopefully 100 million in revenue at some point, or more, and really over a billion plus in valuation. So you're really just pumping in more capital, more mature, larger check sizes of capital to just make the company really scale. And then buyout means, this is kind of the later stage of private equity. You'll go in and just buy out a company. So for example, if you're Google and you have this, an amazing AI team, right? I mean, the best AI teams are probably working at Google, but, for them to develop some technology, if there's already a startup that's already doing the technology, then it's easier for Google to buy out that company. And now those employees just become Google employees. So there's value in buying out just to get speed and velocity and larger share of the market versus you trying to build it yourself. So that's why people go into buyout. What's also special about buyout is all that revenue that company was generating. Now, when you acquire it, that's your revenue as well. So I want to unpack venture capital and private equity just one more level deeper. So the whole concept of venture capital is very risky, right? 9 out of 10 startups usually fail, but you just need one. You just need that one Uber. So this is the list of the investors from Uber. So as you can see, Jason Port, Sean Fanning, they both invested 25,000 into the company. Their money eventually turned into 124 million over time, right? So these are high net worth individuals. The only reason why they were able to write such small checks is probably because they're OGs in the Silicon Valley ecosystem and they have a relationship with Travis Kalanick, who is the founder of Uber. But normally you wouldn't be able to write a check that small. But this round, it was the friends and family round, super early. Travis only let a few people in. But typically, a fund would come in for, on average, probably like 250 to 500K checks. These are all kind of the early angels. So if you do have that liquidity because you're a successful business person, you come from a wealthy family, writing, anywhere from 25,000 to 6 figures is a drop in the bucket. But this shows the power law. That means you invest even a small amount over time. Hopefully that gives you like 1,000 to 5,000x return. So Garrett Camp, because he had a little more cash because he sold the company StumbleUpon, he was able to put in 200K, and that 200,000 turned into $1 billion. When the company eventually went public, Uber. So just keep in mind, venture means you're investing super early. You might have to wait 10 years to see any money, if you see any, because it's super risky. In 10 years, half of your companies that you invested in might have failed, but that's why there's funds. You work at a fund, the fund is investing in tons and tons of companies. So they're doing this for outsized returns, and they know that it's super risky. They know some companies are going to die. So they need to find the best companies. They need to source, pick, and win. So they need to find the next Uber and hopefully find 5 more Ubers and allow those companies to either get acquired or go public so that everybody makes their money, but again, just to stay laser focused, venture capital means you invest in a company. You might have to wait anywhere from 7 to 10 years until that company really, really grows. And then when you make your money is when that company gets sold to another company through a buyout, right? Or there's an IPO where your shares now are on the stock market. And the share price is much higher than when you got it. Maybe the share price is $18 or $20 a share when you bought it for 50 cents a share because you were in so early, right? So that's where the power law, the multiples go up really high. Now, private equity, you might see some of these faces here and be familiar. Sam Zell is one of the most famous private equity investors. He used to be in real estate, and then he got into PE. So they say if you want to make your millions, get into real estate. If you want to make your billions, get into private equity. Steven Schwartzman is the founder of Blackstone. I think he's worth around 40 billion now or more. And they manage about $1 trillion in assets. And then you probably are familiar with Elon Musk. He's made some private equity acquisitions, right? He now owns Twitter and has bought multiple companies. So private equity is the concept, as I mentioned before, of buying businesses. So these companies are more thinking about buyout under the subsector of private equity, and you're using debt to be able to buy those companies. When you think about venture capital, you're using equity. So that means I'm going to invest $200,000 in your company, and you're going to give me 15% ownership in the company. That means I give you money for ownership or equity. That's equity. For debt, you're raising a bunch of debt, and then you got to just pay interest on the debt, pay it back. But hopefully what happens is the company does so well because you're buying a company out and then you sell that company for $1 billion. The returns of that exit from when you came in is much higher than the interest anyways. So then the risk of paying back the interest of the debt is mitigated because you're in private equity generating massive returns. And the multiple is going to be less. It's not going to be 1,000x multiple, but you're using debt to be able to buy companies, and hopefully those companies, sell and provide money back to everybody as a great return. But here's some of the basic fundamental differences between early stage venture capital and then I would say late stage or buyout in private equity. Mainly the ownership, right? So venture capital, you have a small ownership, and you're mainly investing early stage. Early stage is a broad categorization right now. Early could be now pre-seed or seed, just the idea stage. But early stage could also be Series A. But, as you can see on the flip side, private equity, they're looking to kind of take majority ownership and control of these companies. So, the ownership could be anywhere from 80% or more, or venture capital, they're trying to just take a small ownership and hopefully get an outsized return over time. Private equity is late stage. So again, it could be growth equity or buyout. The type of vehicle that is used for the transactions is equity for venture capital. That means, look, just like Shark Tank, I'm going to give you 200,000 for 10% of your company. For private equity, hey, I'm going to use debt, and then hopefully that multiple gives me a return. So let's talk about the multiple. The multiple means if you just take what you made and multiply that by a certain X number, that's what your return would be. So I'll do simple math, right? You have a $2 million valuation on a company, and then a year later, the company is now 4 million, right? So that's a 2x multiple. So with venture capital, you're hoping that you get 1,000x to 5,000x multiple, right? I invest $25,000, 10 years from now, I become 124 million in return. So that's like a 5,000x multiple. Where private equity, you're hoping to buy somebody for, even if you buy something for 30 million and it only 3x's, that's 90 million. That's not too bad, right? So you're taking smaller multiples with larger magnitudes of capital to be able to put that massive amount of capital to work. There's institutions, there's pension funds that are making money, that are making like less than 3% a year from putting their money in a money manager that's managing a pension fund. So they want to put that money to work and take bigger magnitudes of capital and maybe put it into a private equity fund or put it into a private equity deal. That way they can at least get 3 to 5x, so that's a big difference. So if you're working at a firm, whether it's a private equity firm or a venture capital firm, you're mainly going to be doing investing and you're going to be portfolio monitoring. One thing I didn't mention here is also you're going to be doing fundraising at some point, right? So let me go ahead and add that in here, because you can't do any investing without fundraising from LPs. Now, you may, depending on your role, you may not always be fundraising. Your role would probably be just, if you're a principal, the fund is already raised, but essentially, if you want to have a fund, you got to raise money from wealthy individuals or institutions, to be able to have them invest in your fund. So family offices are wealthy families that have set up their own investment firm at their family. That's a typical LP. LPs are people who give money to funds. Sovereign wealth funds, insurance companies, pension funds, endowments, all those people are managing money and they want to allocate their money into something that can make them some additional return. So, if you're a general partner at a fund, you may be responsible to go out and raise money from LPs. So you got to be good at pretty much sales and helping people understand why your fund is so great. And then let's say you raise the fund, right? You and 1 or 2 partners, you guys go out to market, you have a great network of LPs and you go out and raise a $100 million fund. Now you got to put that money to work and you need to generate returns. So there's a whole process of investing, so you're going to be sourcing and screening deals. Deals are companies that you can invest in. So you're going to be going to events. People are also going to be contacting you because they know that you work for an investment firm. So everyone's always looking for funding. So you're going to get out, you're going to do your own outbound, do research on your computer, build relationships with other investors, cold message founders. Sometimes investors will give you great recommendations of companies, and they'll also share companies that they invested in, because the companies that they invested in also need funding. So they could use you and your help to kind of maybe write a check to help their existing companies grow. You will also be cold messaging founders, and you'll have to kind of think about how you're going to do that in an emotionally intelligent way. And then, as you're reviewing these deals weekly, usually every Monday, there's a Monday investment committee or partners meeting. So in those Monday meetings, you need to be able to bring in your A game and bring in the best deals that you think are going to be good investments. Let's say after the Monday meeting, there's a good reception to the company that you brought in. Now you're going to get into some diligence, and the diligence, you have to be mindful of your time and you have to make sure that it's worth your time to do all this due diligence. But if this is a really hot deal, you need to do the diligence. So the diligence, the first layer is really just getting some more information. And there's usually a checklist that you can use. Maybe in one of these other sessions, I'll do a diligence checklist. And then there's probably layer 2, layer 3, layer 4, even sometimes, to make sure that this company is a good company to invest in. So some venture capitalists that I've spoken to have done background checks. They've asked for bank statements to make sure that the money is actually in the bank. And any founder that refuses that sometimes could be a red flag. Obviously, when you're about to do a deal too, you want to put together a document called an investment memo. That's kind of a summary of just how you see the world and why you think this company should be either investable or non-investable. And then, if that investment memo gets some good feedback, and the deal is getting good feedback, then you can vote with the team to have an investment committee. And the investment committee is really the final meeting before you make an investment. Now, after you've made all these investments, you raise a fund, the final thing is portfolio monitoring. So you need to make sure that all of your companies are still doing well. You need to get updates from them, even if they're not doing well. And then you're going to have to share some of that information as updates to your LPs. And, you need to make sure that you're building, this platform in a thoughtful way so that you can have a repeatable machine of great companies that you can invest in to generate returns. And hopefully those companies are going to be able to create some type of positive impact. Finally, I'll end with just in general, how does a fund work? So there's the fund, and then we talked about raising money, right? There's LPs. LPs are called limited partners. Limited partners are the people that are actually giving money to the fund that usually gets wired to the general partnership. So the general partnership is the main entity in a fund that actually does all the investing, and they pretty much are doing the majority of the activities. The management company is where the returns, the management fees, they go up there. So the management company is really kind of, as noted, managing and maintaining the structure of the fund. And then the general partnership is where the tactical work is done, right? So as you can see, there's two sides. There's the fund side, and then there's the investors who are the LPs. So again, the management company is just kind of usually an entity that sits on top of the general partnership, and then the general partnership usually has two general partners that are deploying the capital. Where does that capital come from? Comes from the limited partners. Limited partners, again, are family offices, pension funds, endowments, high net worth individuals. These are people that want to invest in funds to get the diversified access. So these LPs in this example, let's say there's only 6 LPs, these LPs are like, look, we're going to write a check into this fund. We love what you're doing. You have a unique, thesis. So we're going to invest in your fund. So the money comes from the limited partners and it goes into the general partnership, which is usually like a bank account that's set up at a certain bank. And annually, to manage this money and to find all these amazing deals, the limited partners, once they get the capital, they're going to need that capital to go do marketing. They got to pay for all their expenses. So there's a 2% annual management fee on the size of the fund that goes back to the limited partners. So they get charged, but in terms of like how that impacts them from a tax standpoint, or when they get some money in the bank, those are all things they have to talk to their CFO and accountant about. But anyways, they invest in the fund, they get charged a fee. Now this general partnership has a bunch of portfolio companies, right? These portfolio companies, let's say the general partnership, they've invested in like 6 companies. Some of those companies are home runs and they're crushing it. So, there's a gain, right? You get into a company, it's worth 10 million. Now the company is worth 30 million. There's a 20% gain on that company. So that, and maybe that company just gets sold, right? So if that company gets sold to a bigger company, now there's like 20 million worth of cash that's in the bank account of the fund. So that 20 million, the gain, there's 20% that goes to the fund because that's their success fee for finding a great deal. And then 80% goes to the limited partners. So that's how the limited partners make money. And then sometimes what happens is like the limited partners are so happy, they're like, look, we're going to invest in your next fund. Usually there's like a fund one where first time fund managers will launch a fund and it's like a $10 million fund and they crush it, right? I mean, hopefully they go in there, find amazing unicorn companies. And then the limited partners are like, wow, I like the way this machine is working. When's your next fund launching? And then the general partner says, look, when the next fund's launching in 2 years, in 18 months or over 18 months. So the LPs can go in and say, look, we don't want to like give you more capital. We might later, but for now we're going to pass on giving you extra capital. But we have so much liquidity from these companies that you found for us. So we're going to recycle our proceeds back into your fund, your next fund. So hopefully that was helpful. Again, there's a fund and then there's people that invest in funds. And then there's a success fee because obviously the fund is doing all the hard work of finding the deals. And then the management fee that they charge really helps them run the fund, right? They have to go to conferences. They got to hire staff. They got to, buy an account. They got to buy a Zoom account. They got to buy all these tools and platforms. They got to travel. So all of that gets covered hopefully in the management fee. Obviously, the bigger the fund is, or if you launch your own fund, the more assets you raise, then your management fee is more meaningful and more healthy. But you're not doing this business just to collect fees. You're doing this business to generate outsized returns for your investors. So hopefully that was helpful. That's just kind of like a 101 on like what is VC, what is PE, and just a couple smaller subsets of details. So anyways, really enjoyed doing this, and I hope that we get to do another session live. So we'll chat soon.